Let's go! Today we take a comprehensive look at financial landscape, including gold, Bitcoin, housing, 60/40 portfolio, what you need to do to adjust your strategy, and of course, what this channel is all about. Let's dive in. Screen share on. Okay, I put a lot of thought into this, how I want to structure this channel, how I want to produce videos, and at least in the beginning, none of this will be perfect in any way, and I'm fully aware of that, so I'm just gonna hit record, share a few of my thoughts. I asked you guys in the Telegram community, how should I do these videos? You want to do that with a cam, you want to do it faceless, you want to have deeply researched and scripted, or if you prefer just freestyle, me rambling on. And a lot of you guys said just do it freestyle, so this is what I'm doing. Right here on the page, first of all, press that subscribe button if you didn't do so, and then scroll down here and you can see especially Telegram link. So we have this Telegram community where I bounce off ideas on how I want to do this, what I want to talk about, and I ask you guys. So I want to make this a journey where you guys are at the center of it. So I want to bounce back ideas. I want to ask for your opinions on how I can structure this channel that you enjoy it. This is my first video, one of many, and maybe just as a beginning, I'm in no way a financial advisor. I don't do trading. There is a disclaimer down in the description of this video. And the things that I'm talking about are mainly broader trends from a bird's eye perspective that are valid for a multi-year period, 5-year period, 10-year period. I'm not interested in trading short term. But there are some clear trends you can follow, and this is exactly what I want to talk about. So first things first, 60/40 portfolio. Some of you might know that as an all-weather portfolio. Others call this a beta portfolio. The basic concept is 60% stocks, broad indexes, 40% bonds. Most of us, especially if you're young, you will never have 40% bonds in a portfolio. Usually, or at least early, they were called the risk-free return. Now they're basically return-free risk. You don't really get any real rates. Inflation is higher. So if you're young, it doesn't make any sense to have 40% bonds. Yeah, I would make the argument that it doesn't make any sense to have any bonds in a portfolio. If you're younger than 40 years, you probably shouldn't have bonds. Now let's talk about the 60% stocks. So this portfolio worked exceptionally over the last 10 years, maybe even 20 years, because we had a up-only bull market, buying the dip, one financial crisis in between that was very short, and that's it. It was practically buying the dip all the way up. And a lot of us got accustomed to this kind of easy investing. So if we're just looking at a chart of the S&P 500, it was practically up only since 2019. But this is in no way normal. And especially there's one thing that changed, and this is the demographic setup. So you have, let's say, 95% of the world. Let's look at a map here. Maybe this one. Okay, let's look at a map. So the United States, Brazil, China, Europe, and Russia make up 95% of the global GDP. So almost everything. And demographics in all of those regions peaked in 2019, which means that if you just look at a broader population here, and let's go to 2019. So right now, all of these areas where you can see people older than 65, they're like 20%-ish. If you scroll 20 years into the future, so let's say 2040, most of these grew exceptionally. So from low 20% into high 20%. And also these areas in the middle, they grew as well, which means from now on until 2040, you have more people leaving the workforce than entering them. So a consistent demographic downtrend, which makes investing in broader indexes like the S&P 500 a losing game. Very likely with elevated inflation and an allocation into a 60% index portfolio, you're probably gonna end up making a zero-sum game, so no gains at all. If you factor in inflation, it could even be negative. So the investment game that was true for the last probably 70 years, that worked exceptionally well, like time in the market is better than timing the market. Just put them in indexes and do a rebalancing once a year. This is dead. From now on, you will need to adjust this strategy, and you will need to apply a little bit of active management into your portfolios. And so let's look into the reasoning for that. If you look, for example, at countries here in Europe, like Germany has a fertility rate of 1.5, Switzerland as well, the Netherlands is doing slightly better with 1.7, so does the United States. All of these countries, they have declining demographics. And even though you could fill this up with immigration, it doesn't translate into clear economic growth. Meaning index investing in Europe and index investing in the United States is probably not what you want to do over the coming 10 years. You rather want to pick sectors. So going into a specific sector like healthcare, because of a growing aging population, this could be a very interesting sector. And you want to go into regions. And the regions that you probably want to go into are India and Africa. Just because if you look at the demographics here, you only have about 4% in Africa and you have about 14% in India. In Africa, you have a fertility rate of around 4. You need 2.1 to keep the population flat. And in India, you have 2.2. And India will grow to be the single biggest country just measured by population until like 2035. So these are probably the areas where you have clear demographic growth, somewhat of an industrial revolution. So probably one of the best sectors or industries to invest in. And now let's briefly touch on the last 10 years in the S&P 500, up only. And there is this myth or this saying, time in the market beats timing the market. And I completely disagree on that. While it is true when you look at a 100-year period, you're probably not going to live 100 years. You have about 40 to 50 years to get your investment strategy settled. And if you want to retire a little bit early, timing is exceptional, is super important. And there were several times when you were investing, like for example, if we just scroll back here, in the 2001 area, so in the .com, if you were buying into a broader index here around 2000, you were waiting 13 years just to break even. And 13 years is a long time in the time horizon of an investor, especially if you're considering retiring in 10 years or in 20 years. 13 years is a massive time. So if you're thinking about, okay, I'm just gonna have a broad indexing strategy and I'm gonna buy here, maybe you started investing in 2018 or 2019, so you were buying here or here, you were probably buying the top. And there is a very big chance that you need to wait 20 years until you can recuperate on your investment and actually make a profit. So what is actually interesting right now? We talked about 60-40, probably no bonds, and instead of S&P 500, sector ETFs and region ETFs. But here comes the but. Here you have a diagram by BlackRock, and usually it's bonds up, stocks up at the same time. Only in a very brief periods of time this is not true. Like for example in the late 60s and during World War II. And we are likely entering a similar period where the investment game is completely changing. At least that's the point I want to make. So we're addicted to the easy money. We had extreme money printing going on for like about 40, almost 40 years with like exceptional growth in money supply over the last 2 or 3 years. And like if we are money printing, this translates into rare assets. Now, what kind of assets are rare? Like, where is the trend happening? And I would make the argument we're going into a commodity super cycle, meaning for the next, let's look at the charts. We have commodities, for an example, we are using gold here. Gold was practically sideways from 2011 until 2023. So let's say 13 years. And if you just compare this, gold is moving, when stocks are moving up, gold is usually having a bear market or a sideways market, and the other way around. So logical conclusion by looking at the past is we had sideways movements for around 10 years in gold, and we had a crazy bull market in stocks. So what could happen within the next 10 years? Probably we're going to have a bear market in broad indexes, and we will have a bull market in gold and other currencies. Now, a lot of people think, okay, gold wasn't a good investment over the previous years, and it was much better to be in stocks. And this is not completely true. So, for example, if we're looking at the .com era, if you would have invested at the top of the .com era in 2000, you would have been up 600% on gold, and you would be 100% up on the S&P 500, which is a big difference. So especially in times when you had a bull market of like 10 years, you probably don't want to be cost averaging into big indexes at the top. You want to behave anti-cyclical, meaning commodities are exceptional to buy right now. And personally, even if you look at a 50-year period, gold did exceptional against, just compared to the S&P 500. Now, you have other categories that are super interesting because, like I would say, we can agree that we are moving away from the US dollar as a world reserve currency, and you can see that, for example, China or Russia and India, other great countries, they're stocking up on their gold reserves. And gold is probably not the end-all be-all place. There are other places, and you know what I'm going to say, you probably want to diversify into Bitcoin. So if you don't have any, and this is just the advice that I'm giving in general, so it doesn't really matter what age you are, but if you don't have any exposure to Bitcoin yet, you'd probably want to have 1 or 2% of your total net worth in Bitcoin, just as a hedge, an asymmetric investment, comparable to gold, just because it's a super scarce asset. There's only 21 million, and everybody is looking for these censorship resistant currencies that you can take anywhere. Nobody can take them away from you, even countries and institutions, not only individuals. It's very, very interesting for everybody, and it can really give you a specific upside to a structured portfolio. The breakdown of a specific portfolio, I'm going to touch on that in a future video. This is just the bird's eye view. Let's go into the map again. So one thing that is very, very important to understand. So the West, which I would consider United States and Europe broader, we have this demographic decline, and a lot of other regions in the world, which is mainly Latin America, and Russia and the Middle East and Africa. So almost everything besides Europe and the United States is moving to trade with China. By a large majority, 70% of the world is moving to have China as their number one trading partner. And this could be helpful for China's development over the coming years, but what China has is an even bigger demographic issue because of the one-child policy that they were running for multiple decades. So I wouldn't recommend in broader China for the last 10 years. It could be a short-term trade, but India and Africa are a much better place to be, at least for the next 10 years. Just in general, where you can see this global trend moving away from the US dollar, and this is why Bitcoin and gold are such great investments to add to your portfolio, is... So 26 February last year, with the start of the crisis between Ukraine and Russia, we saw the United States confiscating the foreign exchange reserves of Russia. Now, if you're another country like China and you see this happening, you probably don't want to own a lot of US dollars or US bonds. You want to diversify, and this is why we are seeing all these countries loading up on gold. It might be a little bit early for Bitcoin, but at one point it's completely on the table that countries are starting up, loading up on Bitcoin, because it's one of these assets that cannot be confiscated and that can be used to settle international trade where nobody has a certain advantage. So Bitcoin as the wild card for the exceptional upside, low percentage, some gold, sector ETFs, and region ETFs. This is definitely how the meta is moving. So 60-40 all-weather beta portfolio. This is not the thing you want to do over the next 10 years. You want to be in specific sectors and regions. Which ones and which ETFs you could use, we're going to look into in a future video. So one of the indexes I personally use, and you can see its growth over the last 5 or 6 years. It's more or less flat, and this is mainly because we had a strong US dollar. So this downtrend was mainly because the US dollar was so strong in 2022. But right now we are completely in a range where it's very suitable to start entering a nice position in an emerging market index. Okay. Now, one last slide on housing, which, if you're like me in your 30s and you're looking to buy a home, or you already bought a home, you're thinking about buying, or you think about selling, demographics matter heavily when it comes to housing, because as you can imagine, as the workforce shrinks and we are not making enough kids, at one point there will be too many houses for too little people. Which of course means that the housing prices need to fall. And here on this slide you can see like the demand for housing shrinked by 40% just in a matter of a few months, which was probably gonna say, like, with rising mortgage rates, demographic developments, that housing has seen its peak. Also on housing I want to make a dedicated video as well. Now, just to go back to the start, I gave you a little bit of an overview on what could be changing over the next decade. If you found this interesting, I'm gonna make a deep dive on every single topic that we are mentioned on. A topic on sectors, so which sectors could be interesting, a topic of regions, dive into regional ETFs, especially Africa and India, which I personally would consider two regions with the strongest upside just because of the demographic. Of course, there will be dedicated videos about Bitcoin and about gold, and probably also about housing. This was the first of many videos, and I know it was a little bit unstructured, but this is a little bit of the format that I want to keep and that I want to do because it's low in production value. I just can share a few of my thoughts and upload these on a regular basis. I'm probably looking at one video a week, maybe 2 videos a week. Let's see how it goes. It depends also if there are interesting things or interesting trends happening. If you enjoyed this, once again, make sure to hit that subscribe button, activate the notification bell, and scroll down here, join us on Telegram. We have about 150 people in there. Every discussion, every topic is fair game. Just let me know what you're interested in. I'm reading every question, answering every comment there, and let's have a lively discussion. Also, please jump into the comment section and let me know what you think about this video. Was it too general? Was it too unstructured? Or did you enjoy the format as it is? I'm very, very happy to take feedback, positive, negative. Just let me know how I did. With that said, I hope this is just the start of a lot of new videos in the future. And thanks for tuning in. See you next time.